Legend Biotech, ticker LEGN, just completely beat consensus across the board for Q2 2026.
Well, yeah, a massive beat.
Right. So actual EPS came in at 9 cents, beating the 7-cent estimate, and they had an adjusted EPS of 16 cents. Revenue hit $387.5 million. I mean, that's a massive 51.9% year-over-year increase, just crushing expectations of around $356 million.
And the guidance was strong, too.
Exactly. Management is projecting adjusted net income profitability to continue right through the second half of 2026, with sequential global revenue growth expected in Q3 and Q4.
But the stock reaction was, well, it was wild.
Yeah, shares initially popped over 5% pre-market, hitting 21.70, but then literally the very next day, the stock just reversed and dropped 5.4% following a major analyst downgrade from Oppenheimer.
So we basically have this major top line and bottom line beat, followed almost immediately by like a really harsh reality check from Wall Street.
Which is exactly why we're doing this deep dive today. We're pulling together the Q2 earnings call transcripts, the latest analyst notes, including that Oppenheimer downgrade, and some recent clinical data drops from Legend's pipeline.
Right.
Our mission today is to figure out how a company can deliver such a, massive financial beat, yet still face that kind of severe skepticism from the market. We've got to look at what's actually happening under the hood of their commercial rollout.
Yeah, and if we connect this to the bigger picture, this quarter represents a massive fundamental milestone in the life cycle of any biotechnology company.
Oh, absolutely.
What you're looking at in these earnings documents is Legend's transition from a, cash-burning development stage biotech into a genuinely commercially profitable enterprise.
Right.
I mean, this marks their first ever quarter of company-wide profitability on both an IFRS and an adjusted basis.
And just to clarify, for those of you modeling this at home, IFRS stands for International Financial Reporting Standards. It's basically the global accounting framework, kind of like the equivalent to GAAP used here in the U.S.
Exactly. And hitting profitability under those strict reporting standards is a threshold that, honestly, the vast majority of biotech companies simply never cross.
Yeah, they usually just run out of capital.
Or they get acquired,
right,
long before they ever generate positive net income.
It really is the ultimate validation for the sector. You spend like a decade burning hundreds of millions on research, and finally the math actually flips.
Yeah.
And looking at the breakdown, the specific engine driving that $387 million in revenue is exclusively the CAR-V-YTI franchise. Let's dig into that segment performance data for a second.
Let's do it.
So CAR-V-YTI net trade sales hit $657 million globally. And Legend takes a 50% split on those sales through their collaboration agreement with J&J.
Right, Johnson & Johnson.
But the geographic split is where the numbers get really interesting to me. U.S. sales grew a very healthy 32%, but international sales absolutely skyrocketed by 128%.
Which is just staggering growth.
Right. They're now operating in 19 different markets, including a brand new launch in Ireland, and they've expanded across 348 activated treatment sites globally.
That international expansion is clearly starting to pull its weight in the revenue mix, for sure.
Yeah.
But as an analyst looking at the accounting mechanics, there is this technical detail here that CFO Carlos Santos emphasized regarding that foreign growth.
Oh, the FX stuff.
Exactly. It's something you really have to factor into your models. Legend receives its collaboration revenue in U.S. dollars, right?
Mm-hmm.
But the strict accounting rules require them to convert that revenue based on Legend's specific foreign exchange rates.
Because they're reporting internationally.
Right. And because those international sales are rapidly becoming a much larger percentage of their total revenue pie, we're going to start seeing slight divergences between the top-line CAR-V-YTI revenue that J&J reports and the collaboration revenue that Legend ultimately recognizes.
Right, just because of standard currency fluctuations between the euro, the dollar, and, other local currencies.
Precisely. It isn't a fundamental flaw in the business or anything. It's really just a hallmark of a maturing global footprint.
Yeah.
But if you're building a financial model for Legend right now, you can no longer just take J&J's reported CAR-V-YTI sales, divide by 2, and paste that into Legend's top line. You got to account for the FX drag.
Okay, that makes sense. Let's unpack this domestic growth, though, because the underlying dynamics in the U.S. market are shifting dramatically. The notes show that over 70% of U.S. volume is now coming from earlier lines of therapy.
Yeah, the second to fourth line.
Right. And for context for you guys listening, CAR-T therapies originally gained approval for patients who had already failed like 5, 6, or even 7 other
It
treatments.
was the Hail Mary pass.
Exactly. It was the absolute last resort when nothing else worked. But now, oncologists are deploying CAR-VYKTI much earlier in a patient's journey. It's basically becoming the standard mid-game play.
That's a good way to put it.
But I'm looking at these growth numbers in early line therapies, and, well, administering CAR-T requires a massive logistical lift. Got to extract the patient's cells, freeze them, ship them to a lab, re-engineer them, and ship them back.
It's intense, yeah.
So surely they're going to hit a wall with clinical capacity soon, right? Pushing this into the second-line setting means a massive, massive increase in patient volume.
You're zeroing in on the exact friction point that has historically constrained the entire CRT industry.
Right.
Clinical and manufacturing capacity is always the bottleneck. You can have the most effective drug in the world, but if there aren't enough specialized hospital beds or trained medical teams to safely administer it—
And monitor for the toxicity.
Exactly. Monitor for severe immune reactions. If you don't have that, your revenue growth hits a hard ceiling. But what the data shows this quarter is a really fascinating structural shift in how and where this specific therapy is being delivered.
Because of the community hospital.
Yes. Legend's management noted that 40% of their authorized treatment centers are now community hospitals.
Which is a massive departure from the old model. We're talking about local, regional cancer centers here, not just the massive specialized academic research institutions in major cities.
Exactly. They are actively decentralizing the treatment model.
Huh.
The logistical hurdles you mentioned, extracting cells, managing the chain of identity, monitoring toxicity, it used to require the infrastructure of a massive university hospital.
Right, right.
But by investing heavily in training and standardizing protocols, Legend and J&J have expanded their network to 348 global sites, pushing heavily into those community settings.
Wow.
And this does two things. First, it directly alleviates that clinical capacity bottleneck you were worried about. You aren't forcing every patient to travel to one of, 50 elite hospitals.
Right, which is huge for access.
Huge. And second, this rapid adoption and wider availability fundamentally shifts the market landscape. Competitors who can't scale their administration footprint and train community oncologists as quickly, they're simply going to lose market share.
That makes total sense. That rapid expansion into community hospitals is clearly driving top-line revenue, but, and here's the catch, servicing hundreds of decentralized sites completely rewrites the unit economics.
Oh, absolutely.
Let's look at the margin mechanics because the swing here is staggering. Operating margins went from a negative 142% in the second quarter of 2023 all the way to a positive 15% today.
Incredible turnaround.
And gross margin on net product sales hit 58%, which is a massive jump from an artificially low 41% in Q1.
Yeah, and we should contextualize that Q1 number real quick. That dip to 41% was largely due to one-time upfront costs associated with expanding their manufacturing nodes,
Right.
which they've now basically unwound this quarter. But the margin story isn't a straight line up from here, and this is crucial for anyone holding the stock right now.
Yeah, what's going on with Q3?
Well, CFO Carlos Santos explicitly guided that Q3 gross margins will actually dip back down to the lower 50% range before rebounding back to the mid-50s in Q4.
Which, that feels entirely counterintuitive. If volumes are scaling up and they're reaching profitability, you expect economies of scale to kick in. Why the step back in gross margin?
So what's fascinating here is the underlying biological and economic cause of that margin dip. It's actually directly tied to the clinical success we just talked about.
Oh, really?
Yeah. Outpatient treatment is growing rapidly. It now makes up about 60% of their treatment mix.
Because they're treating patients in earlier lines of therapy.
Exactly. When you treat a patient in the second or third line of therapy, their immune system is generally much healthier than someone in the seventh line.
Right, that makes sense.
And because they're healthier, they can tolerate the CAR-T infusion in an outpatient clinic setting, rather than requiring an intensive multi-week inpatient hospital stay.
Wow.
But with a higher percentage of outpatient volume comes a completely different set of gross margin dynamics. Inpatient and outpatient healthcare settings just have entirely different reimbursement codes, different discount structures with insurers, and different distribution logistics.
It's a total paradox for the retail investor to wrap their head around. Moving patients to outpatient care is undeniably great for the healthcare system because it frees up hospital capacity, right?
Yeah, absolutely.
And it's fantastic for the patient's quality of life because they get to go home. But for the shareholder looking at the balance sheet, It temporarily scrambles the gross margin mix because the revenue recognized per outpatient treatment comes with all those different built-in costs and discounts.
Exactly. It's messy in the short term.
But management has consistently pointed to a long-term target of 75% gross margins at steady state. Can they actually get back up to 75% if this lower margin outpatient trend continues to dominate the mix?
Well, management remains adamant that they see a clear path to that 75% industry standard.
Okay.
The logic they're presenting to analysts is that as they leverage their massive upfront investments in global manufacturing, and as utilization across all those facilities reaches peak efficiency, the raw volume efficiencies will eventually overpower the makeshift drag.
The drag caused by the outpatient treatments.
Exactly. When a factory runs at 95% capacity instead of, say, 50% capacity,
Right.
the cost to produce each batch of cells drops significantly.
Right.
But, it does require investors to tolerate quarter-to-quarter margin volatility in the interim while that scaling happens.
And navigating those complex margin transitions and scaling a global supply chain, that requires incredibly steady leadership.
And I think that brings us to the elephant in the room, the sudden executive turnover.
Yeah, we have to talk about that.
Former CEO Ying Huang abruptly departed in July, and interim CEO Alan Bash used this earnings call to really try and reassure the market. He explicitly stated, quote, "This is a leadership transition, not a strategy transition."
Yeah, it was a necessary, almost defensive statement to calm the waters. I mean, when the CEO of a multi-billion-dollar biotech steps down right at the exact moment the company is finally hitting profitability,
The market panics.
the market gets incredibly nervous, yeah. Institutional investors model predictability. A sudden CEO departure introduces a variable that just breaks those models.
Right. Bash used the call to emphasize that their core priorities haven't changed. Maximizing CAR-VKTI's commercial footprint, advancing the early-stage pipeline, and just executing on daily operations.
And they made a significant move on capital allocation recently to, back up that operational focus. Legend completed a public offering of 7.7 million shares that raised $212 million in net proceeds.
That's a solid buffer.
Definitely. That brings their total cash position to a very healthy $965 million with zero long-term debt on the books. Management noted this new capital will specifically help pay off a $300 million loan they currently owe to J&J.
And strategically, paying off that J&J loan makes perfect sense. It frees them from debt covenants, reduces interest expense, and really cleans up the balance sheet for pure commercial scaling.
Right.
But that capital raise, combined with the leadership vacuum, is exactly what triggered the stock's post-earnings drop.
The Oppenheimer downgrade.
Yeah. If we look closely at the rationale behind that downgrade, where they slashed their price target from $75 all the way down to $40, it was heavily driven by this CEO overhang.
Wall Street absolutely hates uncertainty at the helm.
They despise it. Oppenheimer also cited concerns over long-term partnership dynamics with J&J and, looming competition. So even though the company is flush with nearly $1 billion in cash and generating a net profit.
The market is still discounting the stock.
Exactly, because they don't know who's going to be driving the long-term strategy.
And to fend off those exact Wall Street concerns, specifically the fear of being valued as just a single product company, Legend's management spent a significant portion of the call highlighting the future of their pipeline.
Yeah, they really leaned into that.
And how they plan to defend against competitors. The immediate competitive threat to CAR-VYKTI comes from a relatively new class of drugs called bispecific therapies.
And we should probably define exactly what those are, since they represent a totally different approach to treating multiple myeloma.
Yeah, break that down for us.
So bispecific therapies are essentially engineered antibodies that have two arms. One arm grabs onto the cancer cell, and the other arm grabs onto the patient's own T cells.
Wow.
Yeah, it literally physically drags the immune system to the tumor to destroy it. And the key here is they're off the shelf, meaning you don't have to custom manufacture them for each patient like you do with CAR-VYKTI.
Right, which sounds like a massive logistical advantage for the bispecifics. But management countered this competitive threat by really emphasizing CAR-VKTI's one-and-done clinical profile.
Which is a huge selling point.
Totally. They argue that patients and physicians strongly prefer a single custom CAR-T treatment that offers a long-term treatment-free interval, right, over continuous, ongoing bispecific treatments.
Yeah, because with bispecifics, the patient has to keep coming back for infusion.
Exactly, which obviously takes a continuous biological toll on their body.
It's a highly compelling argument for patient quality of life.
Yeah.
The ability to receive one treatment and then potentially go years without needing another intervention is basically the ultimate goal in oncology.
Right.
But beyond the clinical competition, the sources highlight other structural headwinds Legend is facing. For instance, as they achieve profitability, they suddenly have to deal with complex corporate taxes.
Oh, right. The tax rate.
Yeah, management expects an effective tax rate in the high 20% range moving forward as they negotiate an advanced pricing agreement with the Chinese tax authority.
Wait, why is a company commercializing a drug in the US and Europe suddenly negotiating with Chinese tax authorities? I mean, that seems out of nowhere.
Well, because Legend was originally spun out of GenScript, which is based in China.
Oh, gotcha.
Yeah, and a significant portion of their foundational intellectual property and early R&D infrastructure sits over there.
That makes sense.
So transitioning into a profitable global commercial entity requires them to establish an advanced pricing agreement, basically to figure out the transfer pricing between their U.S., European, and Chinese entities.
The logistics are insane.
They really are. When you transition from burning cash to making money, the tax man suddenly becomes a massive line item that analysts have to factor into their earnings models.
That's fascinating. But here's where it gets really interesting, though. Let's look at the actual pipeline data they shared to prove they have a future beyond CAR-VY-KTI.
Yes, the LB2501 data.
Exactly. The highly anticipated in vivo CAR-RT candidate, designated LB2501, had some major clinical updates. They presented early phase 1 data at the European Hematology Association Congress for patients with relapsed or refractory non-Hodgkin's lymphoma.
Important to note, it was a very small sample size.
Yeah, only 12 patients.
Yeah.
But at the higher dose level, it showed a 100% objective response rate
Which is incredible.
and an 83.3% complete response rate. They even saw the modified CAR T cells persisting in the patient's blood for up to 116 days, with 0 dose-limiting toxicities. Because of these results, they're actually planning a U.S. IND filing by year-end.
And just for clarity for the listeners, an IND is an investigational new drug application. It's basically the formal permission slip you submit to the FDA to begin clinical trials in human patients here in the United States.
Right. Let's focus on that in vivo mechanism, though, because this is the real scientific breakthrough here.
It's totally different tech.
Yeah. Traditional CAR-RT, like CAR-V-KTI, is an ex vivo process. Think of it like taking a raw recruit, shipping them off to a specialized boot camp halfway across the country for weeks of intensive training, and then flying them back to the front lines to fight.
It takes massive logistical coordination.
And it costs a fortune. But this new pipeline drug, LB2501, is an in vivo treatment. Using that same analogy, in vivo is like airdropping the training manual directly onto the battlefield.
That's a great analogy.
You inject the genetic instructions straight into the patient's bloodstream, and their own body becomes the manufacturing plant, programming the T cells on the spot. It completely bypasses the need for external manufacturing labs.
And importantly, Legend plans to run the early-stage U.S. study for this in vivo drug entirely internally.
Without a partner.
Right. They're using the financial flexibility from that recent $212 million equity raise to accelerate development on their own terms before they seek out a commercial partner.
Smart.
They also casually dropped in the transcript that they're working on yet another in vivo program, LB2505, for multiple myeloma in China, which actually does fall under their existing J&J agreement.
So what does this all mean for you as an investor? Can a company truly de-risk its multi-billion-dollar valuation just by showing early phase 1 data for a new pipeline drug?
It's a tough sell.
I mean, no matter how flawless that 100% response rate sounds, it is still only 12 patients. Is that tiny sample size really enough to offset the single asset risk of relying entirely on CAR-VY-KTI for their current revenue?
This raises an important question about how the market actually values biotechnology companies at this specific stage of maturity.
How so?
Biotech valuations depend heavily on proving platform viability, not just single asset success. What LB2501 represents isn't just a potential new drug for non-Hodgkin's lymphoma. It represents clinical proof of concept for their entire in vivo CAR-RT platform.
Oh, I see.
If Legend can prove they have a repeatable, scientifically sound engine for generating cell therapies inside the body, one that completely bypasses the traditional, time-consuming ex vivo manufacturing supply chain you just described, that fundamentally changes the multiple Wall Street will assign to their future earnings.
Because they can do it again and again.
Exactly. It means they aren't just a company that got lucky once. They're a factory for future breakthroughs. But, and this is the crux of the Oppenheimer downgrade, until that platform produces late-stage, undeniable results in large patient populations, the stock price will remain tightly tethered to Carvey KTI's daily commercial execution.
And management's ability to maintain those profit margins.
Spot on.
All right, let's do a rapid recap for the retail investor listening right now. Legend Biotech has officially crossed the hardest threshold in the industry. Company-wide profitability.
Huge milestone.
Truly. They're successfully scaling a massive, best-in-class oncology asset with Carvey YKTI, which just hit $657 million in quarterly global sales and is rapidly expanding into community hospitals.
Right.
However, the path forward isn't perfectly smooth. They face near-term gross margin fluctuations as outpatient treatments become the norm. They have to navigate a new high 20% global tax rate, and above all, they absolutely must prove their leadership stability to shake off recent analyst downgrades.
Yeah, and I want to leave you with a final thought to ponder as you look at these numbers and evaluate your own positions.
Let's hear it.
If a biotech company can finally achieve the ultimate goal of profitability with a best-in-class product, generating nearly $400 million in quarterly revenue, yet still suffer a severe post-earnings downgrade due to leadership uncertainty and competitive overhangs, does the market fundamentally undervalue the transition from R&D to commercialization? Or is the single asset risk truly insurmountable in the eyes of Wall Street without a permanent CEO at the helm to clearly sell the vision of the future?
That is a great question to end on. Be sure to follow the show for our daily earnings coverage so you never miss the numbers that matter.